interesting events are unfolding in the Bitcoin or cryptocurrency space, I guess, or actually the entire market seems to be in crazy mode right now, and nobody's really sure what's going to happen from now on because the Fed, on one hand, it does have the tools to prolong this, to kick the can down the road further. Of course, there's an upper limit to what it can do, but it still does have these tools, and people should have known by looking at the bond rates for 1 year and all these sorts of things, because you're still losing out. Nobody's really investing in these 1 year or I think they even have 2 years in the United States. I'm not sure, but if they are, I think they do. When I saw the rates, they were pretty low still. I mean, the 1 year is absolutely pathetic. It's like zero point 0.1 or something like that. So how's that gonna beat inflation when really the CPI? If you follow Daniel LaSalle on Twitter, his name is LaCalle in the last, and Daniel just how you generally spell it, you'll know that the real CPI was 6.6%. It wasn't 4.2. They took out some rental expenses or whatever to adjust this CPI even to give the image of a transitory CPI. But anyway, I digress. Hello, this is Ohranje Gallante, and this is the 11th episode of Fostering Freedom. I'm going to today talk about Bitcoin markets and what's the road ahead. So I'm not sure what I'm going to title this podcast anymore, because it's such a weird title, but I'm going to do it anyway. We should talk about what the CPI is and, how it works and all that. So if you don't know, CPI has been adjusted since about 80s in the United States, and then it rippled across the world to be adjusted that way. I think some other country was doing it before that in different ways, and I'll elaborate more on this. But the hint is that they changed digits on their notes, which is basically what CPI does. So, if there's rampant hyperinflation, what Argentina has done, for example, is that they have taken out zeros from their notes to quell inflation or something, as if that's going to help. It's just the multiples still. So, they took out like 3 zeros. So whatever note you get, you just multiply it by 1,000, and that's your original number. And that's their attempt, unironically, to quell inflation. I think it has more to do with actually reducing the printing costs. That's where it comes down to. When inefficiencies like this happen, usually that's what they do. So they don't have to print as many notes of lower denominations when there's far higher denominations already. So that's where it kind of comes to or comes from. So in my opinion, but what's happening in the Bitcoin market and in the market in general, and in the United States and across the world even, and with the CPI is substitution and hedonic, adjustment are two of the main things that they use, and there's other methods as well, which I don't remember at the moment. But these are the two main culprits that have ruined the CPI. The CPI was never meant to be an inflation measure anyway. It's a consumer price index, and that name I agree with, because inflation is something that the government creates. Inflation is just the expansion in the money supply. Inflate, right? And you inflate a bubble or inflate a balloon, and what you're doing is you're entering, you're putting in more air into the bubble, and that's what causes it to expand, right? So that's what happens with the money supply. There's more money now. There's more currency that is generated and put in to the money supply, and then, well, the money supply is basically just a term for the currency pool, and then that dilutes the value of that currency naturally, because if there's so many people demanding so many products, all of a sudden, because there's a lot of currency going around, then the prices are going to rise automatically. So the prices rising are actually a side effect of inflation, not inflation themselves. What they do with CPI and hedonic adjustment is basically, or not CPI, the substitution and hedonic adjustment is basically, they'll say that, okay, so for example, if people were eating corn, right, if they had corn in the basket of their CPI, and the corn price rises, they're going to say, well, this year we're going to, change corn to kidney beans because kidney beans actually are cheaper and are following what we desire from our CPI, which is basically they first, they shoot first and then call it a target. So, wherever the bullet lands, they'll just call that a target, right? So, or something like that. I don't know what the best analogy for this would be, but they basically say that, okay, our target is 2%, and we got to get it anyhow. So they're gonna say, okay, with corn we're not getting our 2%. What we're gonna do, and it's really nefarious if you think about it. They make it seem like it's all academic, and all this neo-thought tradition, this bourgeois decadence of, I guess, neo-tradition, which is rooted in some form of weird secularism, cult of democracy, is helping all this thing, all this fraud be legitimized, essentially. This is complete fraud, right? If somebody in the market were to sell you kidney beans instead of corn and tell you that, okay, well, you asked for corn, but I'm going to give you kidney beans because that's cheaper to me now, you'll say that it's fraud, right? You won't accept it, but the CPI and the government does it all the time. So they'll replace it with kidney beans the next year, right? And with hedonic adjustment, what they do is basically, sorry, I'm chewing gum for whatever reason. I just started it before the podcast done and I didn't stop. So, bear with my unprofessionality or whatever you might want to call it, unprofessionalism. But with hedonic adjustment, what it is, if I remember right, it is, okay, they're going to say that, let's say that you have a monitor. That's what it is in front of me, a computer monitor, and all of a sudden the same model, or monitors in general, they got an upgrade, right? And the price increased. So it's not because of the upgrade that the price increased, but let's say the price increased, but there's some upgrade that exists on the monitor. So it's like, there's a new stand, or maybe the screen improved. What they're going to say is that, well, because this thing improved in that, the price actually didn't change because there was an improvement. Well, if you know anything about the free market and the principle of the free market, which a lot of people are actually disgruntled by right now, which they don't really understand the full picture, which is why they do this. They don't understand the scope of the free market. They think it's like a tool. They think it's a toy. They don't see themselves as a market participant and everything else in the world as a market participant, which is why they fail to understand it. They see it as separate from themselves, separate from the government, separate from everything else, like a toy that they can tweak to get the desired results. Because I'm not getting what I want, that's not the market. That doesn't mean, that's not how it goes. But anyway, I digress. Let's move on to the monitor example, right? So they'll say that the price didn't, actually increase because the product improved. Now, in the market, things get better and cheaper, right? So if you look at an SD card, for example, that's the best recent example that we have. Not all things follow this for various reasons, all the time, because of demand and supply flow, seasonal fluctuations, and all that. But the general trajectory is this, and it happens because of competition. If you put in YouTube, maybe I'll put a link in the description or something like that. But if you put in YouTube, why do prices always go down? Chill time with a TYME, chill and TYME one username. You're gonna learn why the prices always go down. But anyway, look at SD card. What happened there was that storage expanded, but the prices went down still. So you can't really say that, okay, if 256 megabytes on an SD card cost you about $150 in early 2000s or whatever, that now 64 gigabytes should cost you whatever amounts, tens of thousands of dollars in SD card. I mean, according to the CPI lunatics, that's how they're going to calculate it. And it's the BS department, it's the Bureau of Labor Statistics, as Peter Schiff says. They only put labor in there because otherwise it would be completely BS, right? I mean, I think he stole it from someone else as well before him. Maybe it was his father or something, but it's perfect. It is absolutely perfect. They keep changing it, keep tweaking it. But the point is that CPI cannot be trusted, right? Because of all these things. And before the 80s, they were not really doing it. They were not really changing or, substituting these things. So you had, or the market actually, and market participants, that is you and I and everybody else, had a better idea with the CPI what the actual inflation was going to be. And this was a response, if you remember. If you look up stagflation in the United States, even Wikipedia would admit it, or hyperinflation, not hyperinflation, but high inflation or inflationary 70s or something, inflation in the United States, something like that. Mostly it is known by stagflation in the 70s. You'll see that, the CPI was actually high up, it was showing inflation. And because of this, the markets were kind of tightened up and, acting all weird. And to respond to this and have this perma-growth, fall growth philosophy continue, they changed the CPI to their advantage. And this was followed throughout the world. So throughout the world, any kind of inflation numbers cannot really be trusted. What can be trusted is, the expansion in the money supply, the increase in the money supply. And people will lie to you, say that, okay, if the money supply expanded by 25%, then that, your prices didn't increase by 25%. How's that? Well, if you look at the stock market, if you look at the real estate market, if you look at all these different places where the money is ending up at, you'll see where the price went. You'll see where the money is going to. The stock market is going up and up and up, while the economy is not. So the money isn't coming out. It's going into this giant casino. And when it starts to exit out of this casino, then that's when the CPI will start to show up. And this is what is going to happen with the crypto hodlers and these guys as well. Because a lot of people assume that they're going to lose the money, but you don't see how many people are taking out their winnings, right? I mean, the people losing are the ones that are taking out later when they got on a high or something like that. The people winning are the ones that are still taking out at a winning, but maybe, they're taking lower winning, but still they outpace inflation many times over still. So it's a giant casino. And just because you won a lot of chips doesn't mean that a casino is a great hedge for inflation, although, in the United States it may as well be at this point. But this is how they trick you into thinking that, okay, it's not 25%, and because the money markets absorb a lot of it, the inflation is not really going to end up because it goes to the banks and it goes here and it goes there, and they try to reason out of it, but it's all a lie. Ultimately, all that money supply is going to end, or a very large portion of it, because some reserves are still held, which don't really manifest in the consumer prices. It is still going to end up in inflation and consumer price inflation. Now, how is it countered? What's the remedy for this kind of inflation? What do you do when inflation like this happens? And you may have already heard things like, Fed's not raising rates and raise rates and this and that. Now, why is that though? Well, the reason is that consumer price inflation actually doesn't happen or can be countered if the demand for money itself increases. So long as there is confidence in the currency, the money supply, the demand for money is going to increase, right? And because of the demand for money increasing, inflation is not going to be there, right? Inflation is not going to really manifest. And how does demand for money increase? It increases when you have high interest rates, so high lending prices, as well as then savings then increases. So this kind of market, letting the market decide what the interest rate is, increases or decreases the effects of inflation quite a bit. And this actually also makes it so that the productivity is maintained or prolonged. It doesn't immediately lead to a crash of the currency or confidence on in the currency because of flooding the market. You got to make room for it to reabsorb, and that is what Paul Volcker did, to my knowledge. Right? When he did that, what happened was, and this is one of the things that is least talked about, is that when you have high interest loans, what happens is usually that, first of all, loans are, bad loans are taken up by the bank, like the bank absorbs the shock of it. They take your assets, seize your assets, or whatever. But secondly, the loans that are made when you have a high interest rate environment are usually the kind that are productive, right? So instead of loans for taking groceries or whatever, you have more loans for things that are capital intensive, like industrial supplies, machinery, things like that are productive, right? So it's a productive kind of debt that is more encouraged when you have a higher interest rate environment in such a scenario. So despite all the malinvestment that happened because of the money supply increase, it still kind of corrects itself from a national perspective by making the debt more productive, right? So it goes into more productive sectors. It goes into, capital intensive industries and big industries, and all those that are capable of returning the debt are the ones that take it. And a lot of people are saving it as well. And so they're getting the benefit by saving the money. Their money is being invested into sectors that are productive, right? And or loans, just loans that return themselves. And because of this, people are able to reap the rewards of the money that they saved. And because of this, there's a twofold effect. Essentially, what happens is, because of this saving, people now have more money to invest in productive resources. So if you and I save our money, let's say I save $10,000 and the interest rate goes all the way up to 20%, maybe in a year or two's time, we'll have, 12, 14,000, and it's going to compound itself, right? So if I save this amount for 5 years or something, whatever it gets to be compounded, I have a lot more extra that then I can invest into further productive things, right? So, not everybody's going to do that, obviously. I mean, I'm not saying that the market is some kind of productive or, it's essentially value free. So, a lot of people are going to be capable of making productive uses out of that money. It can be as trivial as sending their kid to college. And what that is going to do is once their kid goes to college, maybe he becomes more productive over others. A lot more people are going to become more productive over others. The living standards are going to improve and society is, still going to be maintained. Now, this is not to say that this is an argument in increasing the money supply forever and then letting the interest rates go wherever, because this increase in money supply still takes a lot away from the market. That is that it encourages certain kind of speculation, depends where the money is going to end up, and lots of other things that it throws. A lot of businesses, go down that wouldn't have otherwise gone down. So it's not necessarily true that it always ends up being productive, as a lot of people suggest that, okay, we got to have a controlled increase in the money supply, and that somehow is, a forever productive spiral upwards. No, that's not how it works, because, a lot of businesses still on the way are sacrificed. A lot of things that would have been are not here that require certain stability. It creates a high time preference environment relative to the environment in which a money supply is stable and savings are more appropriate and whatever. So all these sorts of things. Now let's get to what is happening in the Bitcoin market and what I see likely is going to happen down the line. Because when it comes to Bitcoin, I am quite skeptical. I have an article on Substack, which I'm going to link to my description as well. I'm going to link my Substack So you're going to probably find my article there. It's also, I think I have linked my Substack on my Twitter. I'm not sure. But, I'm going to link it, and I talk about in that article. It's all sourced and everything. So there's nothing, there's very little speculation that I do there about Tether and, what they're doing with that. And what I speculate is happening with their gold crypto as well. So there's problems with gold crypto, that it is anonymous. And people think that, gold crypto may be a topic for another day at length, but in short, people think that anonymousness or anonymity is good in a crypto when it comes to gold. Well, you don't want anonymous people to be holding your gold. You want people who are legally liable to be holding your gold in one way or another and subject to international arbitration, so that you can chase them down and know exactly who it was and what they did to your gold and what their promises were. You want it to be contractual in nature. You don't want it to be like a crypto. People who are into crypto do not understand the market for gold. They do not understand what commodities are, how they work, how they're utilized, and all these sorts of things, and how the market actually functions. The commodity market is not really like the crypto market. You can't just copy and paste that formula over here and expect it to work. Even gold-plated notes or, polymer gold notes. I think Gold Notes or something is the website. I forgot, but it's polymer notes. Like Australian currency, or I think even Canadian currency is polymer now. And in between that is just a gold foil, and you just have that as currency itself. So people who say that you're going to carry bricks of gold with you when gold becomes currency. First of all, do these people know how much a brick of gold can buy you? I mean, a brick of gold can, it depends on how big it is, but I forget what the current rate for gold is, but probably a kilo of gold bar is going to get you a luxury car or something like that, or a big giant farmland, right? I mean, if my calculations are not incorrect right now, I don't remember what the price is right now, but it's 1,800 an ounce. So roughly saying, about 10 ounces is going to be 18,000. So yeah, I mean, if there's about 30 ounces in a kilo of gold, that's 54,000 or something like that. So yeah, I mean, absolutely semi-luxury or luxury car in that price. So easily something like that. In fact, I just googled and it's about $60,000 per kilo. So yeah, that's a luxury car in and of itself. I mean, for $60,000, you can probably buy a lot of land, and that's not a lot to carry to buy a bunch of land. If you think about it, if you're carrying $50,000 in cash, I don't know if it's going to come out to a kilo or whatever, but it's going to be something around that ballpark. So it's not really that different when it comes to that. So you can absolutely use gold foil notes or whatever. But keeping that aside, the crypto gold is not going to work because there's anonymity associated with crypto, right? There's no contract. I mean, if there is a contract, if it's like an NFT contract that is legally, bound, then it's going to work in some capacity. But if it's not legal, if it's not a contract, it's not going to work. But what's happening in the Bitcoin market right now, the way I see it, is this is going to increase consumer price inflation further. And a lot of institutional purchasing that is going on, or shorting actually, that is going on, selling, going on with the tech stocks, is going to increase it a little bit. But I think what's going to increase it a lot more is this crypto downfall or whatever is going on right now. So what's happening is a lot of institutions are behind it as well. Of course, it's not just retail guys. It's not just anti-fiat revolutionaries or whatever they want to call themselves as. What's happening there is a lot of people are getting out of Bitcoin and pumping altcoins, right? And you really have to understand how and who is pumping these altcoins, right? So it's not really all you and I kind of people. Just look at the advertisements. You look at all the YouTubers that have certain altcoins, certain wallets, and certain cryptocurrency exchanges and all that. And what's going to happen is that a lot of people are taking out their money out of Bitcoin and into these altcoins that are going up. And in that process, they're going to take even more winnings than what they did with Bitcoin. Or if they got out at a certain time where they're more or less breaking even, then they're going to use these altcoins as a springboard to get out of the market and make some money while doing it. So, this is what's happening. And all this money that is coming out of the crypto market is going to end up in consumer price inflation. All this money right now is not going to go back into the stock market. It's not going to go back. It may go back into real estate or something like that. That is not, traded like a stock market or stock exchange. Actually, it's going to end up in your groceries. It's going to end up in your, maybe real estate and things of that nature. And eventually, even those may start to pop, because right now the housing market is also propped up. The price of lumber being this expensive. What does this mean? Why is the price of lumber so expensive right now? Well, it's because of inflation. There's other factors as well. I heard a talk about from an educated economist recently, and he was talking about how the price, demand surge actually happened because of Canadian lumber, stopped coming in. And now people are increasing the supply from the USN, and that's actually stabilizing, or is going to stabilize the price. But if, money starts to come out from the stock market and starts entering the housing market, real estate market, and the construction business starts going up and up again, it's going to keep that price still fairly high over the mean that has been before. And a lot of this money is going to be used to purchase a lot of new things. We are seeing the shortage of everything. And this is an entire lie that the shortages are actually because of COVID or supply chain shocks or whatever. Yeah, there's a shock, but it's not because of COVID. It's because of inflation. Excess liquidity in the market leads to demand surges. And this is known by everyone who's done any kind of basic economics. They are just trying to fool themselves. They're sedated by modern economists and these hedge fund idiots who are trying to lull other people into keep investing money into, resources or assets actually that are not going to be worth anything eventually. So all this money ending up creating a demand surge is essentially causing supply shocks. And what's happening is that what I suspect is a lot of companies actually bought the lies of the Fed in believing that inflation is going to be transitory. And TSMC, in my opinion, when I looked into what's happening there, they're the biggest idiots in this, so far that I've seen. The chip manufacturers, everybody knows about the chip shortage right now. What they did was they issued private bonds to raise money to increase the supply of chips. Imagine that. Imagine being such a fucking lunatic company that instead of raising prices to your customers, you raise capital by selling private bonds in order to increase the supply. You dumb fucks. The price is increasing because there's so much demand, there's so much liquidity in the market, and therefore you must increase the prices to your raw material supplier so that the supply can be encouraged to increase. You don't encourage it by just having more private bond increases. Now, what I suspect is that perhaps they are contractually bound in one way or another, so they have an obligation to sell it at a certain price in the future, or whatever, because these kinds of contracts exist in a lot of spaces. Someone was talking about gold and silver contracts, and as to why banks actually short silver and gold. And the reason being that a lot of companies, the big names, industrial guys, actually buy their gold and silver from these banks. And the banks benefit when the gold costs them cheaper than their obligated contract price, right? So if they're contracting gold or silver or giving them at a future date for a certain price, and year by year increasing the price with a certain percentage, the bank is engaging in a form of arbitrage where they're basically putting, getting this silver for cheap, getting this gold for cheap, and then selling it at the contracted price, thus making a profit in between. And a lot of people engage in this arbitrage, so they have interest. It's not like there's no interest for price not going down. In the market, there's always interest opposing anything, and for encouraging anything as well. So, the opposing interests come from actually the big names, the big players who have these future contracts to sell forward to someone else. And these, they are the big industrial guys. And what happens when the price rises for gold, rises for silver? The banks then have to take a loss. They have to take the L, so to speak. And, they have to bear the cost while giving these industrial guys the same thing at a cheaper price. Now, this is why they keep shorting the silver market, keep shorting the gold market, and then because they fear what is going to happen is eventually all the low price silver that they're getting from is going to raise in price. And then, a lot of people that will be available to turn their gold over, turn their silver over, would be people like you and I. That's where the supply is going to come from, because all these people that are refiners or whatever, they're going to be looking for, because of the price increasing, they're going to be looking for silver. And because it costs them a lot, and there's a demand surge, they want to get from some sources. And you and I are some of the sources of this silver. Whether you have it in allocated storage or whatever, you can sell it. And when that selling happens, somebody, the person who's buying it, may be a refiner, or maybe a minter, or maybe an industrial purchase or whatever, or a bank even. Banks may buy it from you, and then they have to sell to these big industrial guys where they have the obligation. So that is the outlook for the market right now, as I see it. And I don't know what's going to happen as it goes on. One thing is for certain in my mind. This is not advice or anything like that. I mean, I'm not a financial advisor. I don't have any licenses or anything like that. It is just, it's just what I think is going to happen. Not any kind of advice. But what I think is going to happen is for certain inflation due to this stock market collapse, as a lot of people get out of the market, and put their savings or put their winnings to some other use. And wherever to put it at, it's going to be in the consumer market, most likely. And that's where we're going to see the prices increase. So, that's about it. I'll see you guys later. Peace out. Peace out.